So buyers, you may see a lot of news in the marketplace that's negative. And yes, we're decelerating. I'd call us in a real estate recession, but it's going to be, like Dylan said, a correction, not a crash.
Yeah, it's basically on $1 million, just an extra 2,400 a month, right?
2 weeks ago, we were at 6%. The difference between 6 and 7 is it's over $600 a month in a mortgage payment. That's significant. That eats into affordability. And here's the interesting thing. So everyone that wants to wait till the rates get to the top and think that prices are going to pull back the same, there's market research out there that says for every 1% that the interest rate goes up, properties pull back 4 to 6%. Now, the problem with that is a 1% increase in the mortgage is actually the equivalent of 11% price increase. So if you're waiting for interest rates to get to the top, your mortgage payment, and you're getting a mortgage, your mortgage payment is going to be more tomorrow than it is today.
The mantra is marry the house, date the rate, right? I don't know anybody that has ever paid.
What's that again? What's that again? Back up.
Marry the house and date the rate, right? So if it's your house, if it's a house that you want to live in and you want to be in there forever, marry it, right? But I don't know anybody, really anybody, who's ever bought a house and paid the same interest rate for 30 years, right? Everybody either refinances or they sell, or they sell and they upgrade or they downgrade or whatever they're going to do, right? So the mentality of I'm going to buy and I'm going to get locked into this interest rate and pay on it for 30 years is completely the wrong mentality. Like, I would love to, I don't know what the national statistics are, but if you just go in your circle of friends and your personal experience, do you know anyone who's paid the same interest rate for 30 years? It just doesn't happen. So that shouldn't be a deterrent, right? It's not a realistic deterrent on how people actually pay a mortgage over the long run.
That's why God made refinancing a service that we all do.
Yeah. Well,
Yep.
right. And that's why we were talking about now we're going to move into an arms race where people are going to be getting arms instead of the 30-year fixed, because the arms are shorter periods, the interest rate's lower, your monthly mortgage payment would be lower. That's a good way to do it. I don't do 30-year fixed at all because of what Dylan just said. I think the national average is like every 5 years people are refinancing. So why would you? All your mortgages are interest loaded on the front end and principal loaded on the back end. So why pay the higher rate? You can get the 10-year, 7-year arm. As long as that reaches the goals, that's where you got to sit down and do some planning, because there is risk to that, right? But the arms are probably going to be a very, half my clients right now are doing arms because of this, because we're trying to get that rate lower, and we know we're not staying in the house for 30 years. We're staying there for 5 to 7. Okay, we do a 10-year arm, etc.
You've married the house and date the rate. I like that analogy. Yeah,
and one more strategy that we're advising sellers to consider right now and buyers to ask for is you can still buy down a rate, right? You can pay a percentage towards your rate and maybe bring it down a point, a half a point, 3/4 point. You got to work with your lender and see what their options are. But instead of asking for a price concession on a house, a $10,000 price concession on a house, you could ask for, or as a seller, you can offer to buy down the buyer's rate for them, give them a credit to buy down their rate. And if that's really a stumbling block or something that's putting them on the cusp of qualifying for that loan, you can reduce their monthly payment, like Scott was talking about, by $500-$600 sometimes, depending on the size of the mortgage. But that's something that, if you're smart strategically and you kind of understand that you're working with a good lender and a good realtor, you can work around that stuff and come up with a solution to overcome that objection of the rate being a big problem.
Would you explain just a little bit? I lost you when you said buy down the rate. You can make a deal. What is that?
Yeah, you can usually pay up front like a point, like a percentage point of what the mortgage would be. So if you're getting a $600,000 mortgage, you can pay like $6,000 up front towards it's a lender cost, right? But they'll reduce your interest rate because you're basically paying for it up front, right? So you buy, it's called buying down the rate. So the published interest rate isn't necessarily like what you have to pay. There's deals you can make and negotiations you can make with your lender to actually pay an upfront cost to get your rate to be lower.
There's deals you can make with the
maybe
lender.
Scott can explain it better than me.
No. Well, no,
Does that make sense?
it's called negotiating. It's called
Yep.
negotiating with the lenders. Like, what do I need to do to buy? Can we? And the technical term is buy down the rate, right? Can I buy
Yep.
down the rate? And they'll say, yeah, pay an extra X thousand up front or whatever, put a bigger deposit or whatever the lender's going to want to do. There's certain things that you can do with the lender. Jason popped in a quick question. What are the ARM rates nowadays for Hawaii? Your typical Hawaii bank, like a Bank of Hawaii, a typical Hawaii lender. Scott, Dylan, you guys got an idea?
Yeah, so they're actually, because rates have been moving and volatile, everything's been so volatile lately, they've been all over the board, but between about 0.5% and 1% lower. And what's interesting is actually, like, if you look at jumbo loans, which are going to be a portfolio loan or other portfolio loans, they're lower than the conventional rate mortgage interest rate, which is the inverse of what it normally is. So yeah, they're, look around. We're actually even talking about, because the conforming loan rate is getting ready to go up. We're actually talking about, we'd rather take a jumbo loan, which is typically more money down, harder to qualify for and whatnot, and get a lower rate than doing the conventional rate right now on some of the investment properties.
So Scott, is there a number that you can throw out to Jason for an ARM rate, like an actual kind of a number?
So when I looked this morning, the 30-year fixed was about 6.78 and the ARM was 6.1.
Okay, so like you said,
it's tied to whatever the market rate is, right? So it's going to fluctuate as the market rate goes up. It's going to go up, but it's like could be up to a point lower.
And they change 2 to 3 times a day.
So the rule of thumb is up to a point lower, give or take. This one in this case is like 3/4 of a point, right? Or so, right? So basically, Jason, you're looking at a point below, give or take a point below whatever like a 30-year fixed might be, something to that effect, right? Is that kind of what that bond, right? Okay, all right, good, all right, okay.